Hello and welcome to the Rust Belt Apartment Podcast, where we discuss all things multifamily with a focus on the Midwest's Rust Belt region. I'm your moderator, Peter Graylis, and as always, I am joined by my co-hosts and teammates, Gary Cooper, Anthony DeMarco, and Tony Ranella. Today's guests on the pod are both powerhouses in the financial and debt services industry. Throughout her professional career, Kathryn Cassidy has utilized her skills in sales, marketing, and advertising to benefit many retail, commercial, and real estate industries. She's a licensed residential mortgage loan originator, an experienced multifamily mortgage broker, and business consultant. Kathryn has worked for an FAA mortgagee for 20 years, assisting real estate owners obtaining non-recourse agency loans and developing personal and business relationships with attorneys, accountants, commercial real estate brokers, like the Cooper Multifamily team, and apartment lenders. In 2020, she started her own mortgage and consulting business, CRE Journeyman Financial. She's an agency loan correspondent with a proven track record. Her business relationships with our second guest, Dan Eibler, spans decades. Dan's career in finance started out at Column Financial, where he saw enormous growth in the CMBS markets. From there, Dan moved on to VP and director roles at KeyBank, Red Mortgage Capital, and Lumen, securing both CMBS and agency debt across multifamily, manufactured housing, retail, medical, office, and student housing. He has closed well over $1 billion in loan originations for multi-property types and has quite literally seen it all. Dan has recently accepted a position as Senior VP at Basis Investment Group, a diversified commercial real estate investment platform. Since 2009, Basis has made nearly $4 billion in commercial real estate debt and structured equity investments. The company's flexible approach to structuring provides borrowers and investment partners with a one-stop shop for financing, along with customized solutions for investment needs. Quite a mouthful, but you guys have a pretty serious resume behind both of you. So Kathryn and Dan, welcome to the podcast.
Thanks for having us.
Yeah, we're super excited to have you because, again, there's just so much going on in obviously the capital market space right now. And again, if you only joined this in the past 5 or 7 years, it's been nothing but a sort of a boom market and uptime, and everything's been going the right way. If you haven't gone through some of those down cycles or some of those other sort of different segments of the marketplace, which really affect what's going on today. And Kathryn, I was trying to remember when I first met you. So this would be going back to, I believe, the year 2000. And believe it or not, it was at a softball game, a Noah softball game in the flat, in Tremont. And you and Jeff.
Did you play?
What's that?
Were you playing?
Oh, yeah. I was third base, probably.
I like it.
And or short.
Okay.
Third base then. Met her there. And of course, I was the new guy and nobody had ever heard of the firm that just started in the trunk of my car there. And I'd already got an assignment from Marty Mihal. And I remember you and Jeff looking at me and sort of laughing. You're like, oh, you're the guy that's going to sell Marty's deals that haven't sold forever. And I'm like, yeah, absolutely. You didn't believe me till after we sold it. But Kathryn and her former colleague Jeff, they were great friends and really helped promote me. And I want to thank you publicly for that. You guys really were supportive when we started out, and I think you really helped create some of the fantastic things that have happened in the Northeastern Ohio marketplace. So thank you.
You're welcome.
And, Dan, you were the mystery man for a few years. So I met Dan probably a couple years later. It was about 2003. But you were like the man, you were like the Wizard of Oz. You were like the guy behind the curtain. I'd heard your name 1,000 times, but nobody could ever get to you because you were Column Financial and you guys were doing all the things you were doing. And Shaker's
working 6 days a week and Saturdays at that point until the market crashed.
Exactly. And so Steve Shore and I can't remember if he was still at Fifth Third, if they had started Bloommark or whatever at that time, brought you to a showing we had at Shaker Square with Paul Gabriel, which was the start of his sort of mini empire there at Shaker Square. But it was great to sort of meet the man, the myth, the legend, and we've had a great relationship since. So, but, you know, both of you guys have seen, you know, there's been a number of cycles. I go back all the way to 1983. So we can talk about the savings and loan crisis. And even though we don't talk about office much, we might touch on it a little bit here because of the experts that we have. But you know, it's funny, I've got Crane's articles from, you know, the savings and loan crisis, the early 90s. And it's, you know, every week there was multiple office buildings. Literally every office building on Chagrin Boulevard got foreclosed on in Rockside, in downtown Cleveland. And we all forget that because it's sort of ancient history, but talk about a disruption in what it was. But if you guys could help, you know, where do you think we are in a cycle, you know, right now? So again, everybody, you know, there was a big debate last year. Are we in a recession? Are we not in a recession? You know, where are we at in sort of the cycle of, you know, when you compare it back to, again, the Great Recession or the early sort of crisis at the beginning of the, you know, with the .com crash and 9/11, where do you guys think we are in terms of those other cycles? Maybe we'll start with Dan and then take Kathryn's viewpoint.
I think technically we're not in a recession, right? I think we still have positive GDP growth. So I don't think it's recession. And it remains to be seen what's going to happen. You mentioned office and so forth and changing values and the difference between sellers' view of the value of their property and what someone's willing to pay for it. And all that being said, we're not going to find out about a lot of the commercial deals, the office and retail and so forth, until, you know, much later, until their leases come up, until the deals get worked out. We're not going to see huge problems. I mean, there's rumblings in the market already from institutional investors across the country, big ones giving some big properties back or working them out because they got to maturity and they couldn't get debt to take it out. That's just the beginning. So I think it's going to be a while before we see you know, a lot of workouts, if you will, on that you know, those deals.
I mean, there's still liquidity there, right? I mean, this is very different than 07, 08, the savings and loan crisis, where things actually just froze up and there really, you know, no part of that sort of capital stack was working. Everything's working, even though we've got these, you know, pretty significant headwinds.
Yeah, I think just comparing it to the early 90s too, at that point we had high rates and oversupply. That was a really nasty time. Now rates are not super high. Historically, they're decent. And I think the only issues we might have on the supply side is commercial buildings. We are not oversupplied, generally speaking, for residential. Perhaps certain submarkets, but not here, not in Northeast Ohio.
Kathryn, how about from your perspective? Just because, again, you're unique in the sense that you've got a lot of, obviously, you know, very second, third generation owners here in Cleveland. You got people that have very different sort of profile than maybe the overall market. You know, what are your folks saying to you? Are they panicking? Are they worried? Are they bullish, bearish? Where do you think it stands?
Well, from my perspective, when I started years ago, interest rates for agency loans were 8%. Bank financing was just as high. And with everything, it's a cycle, but you always have to go back to the fundamentals. In order to get qualified for financing, you have to have a good product, you have to have experience, you have to have a net worth, you have to have liquidity. One of the things that I think has changed since the last downturn in 2008 is that a lot of these lenders are anticipating some people will not be able to weather the storm. And I think that I'm seeing more and more of my lenders from a servicing standpoint go back to some of these legacy owners and really ride them very hard into, especially if they have a loan that's maturing, let's say 3 to 5 years down the path. They are reaching out to them like I've never seen. making sure that there's no deferred maintenance at the property, that they're doing what they said they were going to do for the benefit of the investors and the agency papers. I think that some of these agency lenders and commercial bank lenders all have the same mentality, is they don't want to have these properties back. And I'm not seeing from any of my clients that there's any risk of handing the keys to the property back. But with every economic downturn, you're going to have people behind the ball, behind in what they should be doing.
Kathryn, you brought up a point and you're bringing up deferred maintenance, and something that, you know, we're seeing when we're looking at deals right now with our clients, whether they should look at, you know, possibly refi or a sale if they have some debt that's coming up and coming due. A lot of the constraints or a lot of the stress that we're seeing is, what do you think, like in terms of debt coverage, because of where they bought it at and when they bought it at, and the current loans that are in place, and then how they'll be able to refi out of those loans? Do you see stress in that? Or do you think that everyone's fine in terms of debt coverage basis?
I think the owners that have been owning and managing their properties for years, you know, whether they inherited these properties from their fathers and now almost handing it to their sons, they're able to plan accordingly, and they're used to the grind. My fear is some of these smaller, new on the streets apartment investors, these syndicators, if you will, who bought properties at really aggressive sales prices and have done a good job of immediately investing in the property and increasing rents. I don't know if they're going to be able to have the opportunity to pay back the investors in that 2 to 3 year period, which is typical. And that's what I'm concerned about.
Well, Dan, you and I were chatting earlier this week, and you had mentioned that there's $1 trillion in commercial real estate debt coming up for refinance between now and 2025.
Yeah, I actually just heard that yesterday on a corporate call. It might actually be more than that, 1.5 trillion.
I think it's 2 billion. it's probably just $1 billion in multifamily.
Trillion.
Oh,
Trillion.
A billion.
It's just a trillion. There's just $1 trillion in multifamily coming due between now and 2025. So that's a number.
I mean, that's a number that.
Let's talk a little bit about who the capital market participants are. We always say that capital markets, not exactly sure what all that means, even though I use it consistently. And I'm not sure anybody's message has it being the same, right? So Kathryn, back when, you know, or even going back when I started, right? It was like your local banks. You had local savings banks. They were the big banks: Broadview Savings, Cardinal Federal, you know, Security Federal, Horizon Savings. Dan and Kathryn may recognize some of those names. Peter, maybe just a tad from when you were younger. But, you know, they were the dominant financing source. There was no, you know, life companies weren't doing deal. There was no CMBS market. There were no, you know, you weren't really getting insurance company deals. And there certainly wasn't the small agency, you know, Freddie, Fannie programs that are available today. You know, fast forward today, you know, really what are the participants in the multifamily space for capital markets debt? And it can go to Dan, well, probably both of you, Dan and Kathryn, because I think you guys are going to have a slightly different viewpoint just because of different product, different client base.
Sure, I'll start. So you mentioned Fannie and Freddie. So Fannie Mae and Freddie Mac, and also FHA. FHA is HUD, obviously. Fannie and Freddie are private with government backstops, and they're regulated by FHFA. So they've consistently and are charged with providing liquidity to the marketplace. So as we may see things deteriorate or change, or credit change at banks, which are still very active making loans, the agencies are chartered, they're required to maintain liquidity in the marketplace and continue to do multifamily lending. And we're not talking about this on this call, but also to continue to buy and guarantee residential mortgages too, so that liquidity remains in the marketplace. So that's a wonderful thing. It's a good thing. honestly, for me personally, working for a firm that does that business, but it's good for the marketplace. There is money out there to get your loans done. Now the rates aren't
How
at
much,
2.5%.
how much do they do a
3%.
year, Dan? You know, I know they've got volume or cap limits. You know, is it 80 billion, 100 billion? What are the agency limits right now?
I'm not going to get the number exact, but I believe it's 60 to 80 billion a piece.
Okay.
And in the past, they've been allowed to ask for additional funds. I think they just made it last year. So a lot of competition last year from different sources, which I think are not really in the marketplace as much as they were then,
Yeah.
now versus then.
The important part to think about right there, if you said 60 to 80 billion and we've got 1 trillion coming due, there's a whole lot of space, you know, that 90% of it, 90% plus of it's got to come from someplace other than Freddie and Fannie.
Yeah, I mean, historically, banks have done a lot. Life companies do their fair share too. I mean, banks really have been, I think, much larger share than Fannie and Freddie, but that may not be permanent debt unless they swapped it. It's usually, construction term debt.
Gotcha.
Most of the majority of the business is in workforce housing, and over 90% of the units they finance are affordable and affordable to families who earn at or below the area's medium income level. One of the things that I think works very well for the agencies is they want to lend. They often use the term, the loan we all own, share the risk. That means the lenders, the originators, the owners, the investors in the paper, and Fannie and Freddie are all invested in each other. And unlike the commercial banks, who are driven by the demands of the originators, the commercial originators and the VPs at these institutions, they have a bucket of money that they can lend on deposits. And sometimes when the market takes a dip, they get a little stingy with the nickels in their pocket. And I feel like in this and up in the next couple of years, we're going to find some banks not participating in multifamily as much as they were in the past. And it may be due to too much development loans in their portfolio. It may be due to risk factors as it relates to the office buildings that they're concerned about. But Fannie and Freddie have always been there through the ups and downs of the market. And I think that's important.
I agree. I was just
Kathryn,
making, if I could just comment on that.
Yeah.
The banks, it remains to be seen with the headline news we've had recently, but the banks are being subjected to additional regulation that's been talked about, that is coming. They don't know how it's going to happen, if it's going to be dribbles and drabs or if it's going to be one swoop. But I think we can count on the banks being required to take additional reserves against their assets, which they accumulated over the last couple of years when rates were very low, and those assets are not worth what they bought them at. And that's impacted their equity and it's impacted their book. And I think that is another reason why they're going to be hesitant to put more money out. They may not be able to put more money out.
Well, and one of the concerns that I always have when I start to look at a project and a financing opportunity is the capabilities of the asset. And with the crazy prices that we've seen in the buying frenzy, and now we're waiting for this adjustment to not only at cap rates as it relates to the appraisers coming back with a cap rate that makes sense, and lenders who are going to be more stingy with their nickels, and they're going to perhaps not go to the high loan to values on refinances that we've all come accustomed to during the low interest rate environment. It's going to be impactful. I don't think it's going to be detrimental to Northeast Ohio, because I think most people have small enough apartments and they're managing them very well. But I do expect to see some very tough conversations being had with the commercial bank lenders and their ability to loan on the dollars that are out there.
Now, Kathryn, to that point though, I know we're talking about multifamily specifically and residential, but like with the banks, is that sentiment across like all asset type? Or are we just speaking just multifamily in terms of how they're gonna start to risk layer? Because I mean, we're talking about not having an oversupply in residential, and maybe you can just kind of like enlighten me, but like, wouldn't banks get more aggressive towards multifamily in the residential lending than they would with other asset classes that they'll have in their books that they're servicing?
Well, for years, the conversation was always, okay, the interest rate on the street could be 4%, but internally they are underwriting the debt, using and stressing the underwriting to include a higher interest rate environment. I haven't had those conversations with lenders in years. Now all of a sudden, when I'm bringing a deal to the banks and the credit unions, the conversation is, I understand that here's the rate and it's gone up, and don't get angry at me that the changes have happened, but we got to talk about our exit strategy. And the exit strategy for lenders is, how can I get out of this loan? Whether it's a recourse loan or a non-recourse, you want to be able to get out of that loan if you're a lender. And I think it's going to be tougher from an underwriting standpoint and their internal stress tests to reach some of these levels given a new interest rate environment.
Yeah, no, it's a very interesting time. I've been accused of being overly bullish, and I'm still extremely bullish on this market. This woe is me, the world is ending, everything's going to blow up. It's like such a joke. Like, even when you hear interest rates, right? One of the first apartment buildings I bought, the first adjustable rate loan, it came down. It was a 3-year from Ohio Savings, and it came down to 12 3/4. And I thought, oh my God, this is what my parents must have felt like, because I'm only paying 12 3/4, because when I got in the business, rates were 16 and 17%. The capital markets and during the savings and loan crisis, they were 1,000 times worse than they are today, right? Because credit actually froze, where banks, could not make lends. The feds came in and said, you guys have 50% exposure in real estate, and we want you to have 20% exposure. So you can't make another loan till you balance the portfolios. And at that time, you didn't have the securitized products, and you had all these banks that had this, hey, I'm paying 16% on the statement savings account, and I've got these 8% loans, and I can't sell them, and I can't securitize them because that industry didn't exist. So every time you've had one of these sort of cycles happen, you always had some new twist, some new invention, somebody with a very creative financial mind that has come up with an idea that then allows the market to normalize and regulate. And I think the same thing is going to happen here. As you guys said, there's winners and losers in all cycles. But even in a completely up cycle, there was losers in our market. People lost their properties even during the boom times. Even with interest rate or with rental rates and stuff rising, people failed. So it's not just because the overall market's going in one direction, you have that. So it's not a zero-sum game. The sky is not falling. Will there be some readjustment? Sure. And some of the players will readjust and some of the participants will readjust. But again, if you look at the fundamentals for multifamily housing, and you just look at the demographics and the growth and the years and years of undersupply that we've had, the market's going to continue to do well. Again, you don't want to be one of the people on the losing bet, right? And I think, that's been the biggest thing that we've had. One of the things I'll argue with you a little bit, Kathryn, is and we use the term too, the crazy prices and the crazy environment. And if you ask me, I mean, it's just been normalizing. If you look at our market here, this is what the market's been like for 30 years. And, the Phoenixes and Dallases and Denvers and Atlantas and Californias and so forth. So, my argument is I think we're just catching up. And all of those deals penciled, all of those deals underwrote, they all had acceptable debt coverage ratios, even with the cap rates. We don't quite have the rent growth and maybe the population growth in most other places, but I still think there's a lot to be had there, right? So, you guys mentioned it a little bit. Maybe we want to expound on it. So we've had a lot of the podcast syndicators that have bought properties because it's like, oh, I can pay whatever because, money's basically free, right? I'm going to spend $10,000 a unit to upgrade the thing, and then I'm going to raise rents $250, and then I'm going to refi and pull this money out. That if you didn't, first of all, I don't think very many of those guys ever, or gals, actually hit any of those projections. I've seen very few that have, here's what we're going to do. And you look at what they did and it's not even close. Are you guys seeing that from a even before we get into the capital markets, are you seeing that from a performance perspective from, folks that bought a property, they had this business plan, then just didn't execute or it didn't come together correctly? Are you, have you seen the results of that by people coming to you guys for solutions?
Well, one of the things that I think is very telling is that, the apartment owners that were pushed to increase rents, whether it was their investment strategy or they were in the marketplace already and just wanted to keep up with what the competition was doing, we haven't seen. I mean, yes, there's been pushback in certain submarkets with tenants, but they're getting the rents and they're not having physical occupancy issues. They may have had collection issues during COVID, but they're not having significant collection issues that I'm seeing. So it's not like they're getting nervous because of that. I do agree with you that rents were low in Northeast Ohio for way too long. And now we've moved up to a point where some of these tenants are going to be happy to being tenants forever. And those that thought they could be a temporary renter and buy a new house, they might have to sit there longer. One of the things that I think is very interesting is that most of the clients that I work with, they're not concerned. They're watching carefully, but they're not concerned.
I'm gonna interject. And this is just gonna be a quick plug to Kathryn and Dan, because we have mutual clients, and we've had clients that we've worked with on the Cooper multifamily, like disposition and acquisition side of things, that use Kathryn and Dan in terms of like consulting and lending. And, I think this is kudos to Kathryn. And this is going to be a plug to Kathryn and Dan, just in how they consult and how they, their clients. You guys have clients that, in our opinion, or I should say in my opinion, don't have some of those challenges or stresses and constraints that like Gary was kind of bringing up, or some of these, groups that may start to stumble across some of the challenges that the environment's going to cause, because it's not just a close your eyes and, we can, and everything's passive and everything's great type of industry. So it goes back to the fundamentals. And also is the importance of like having people like Kathryn and Dan in their lives that keep them in tune, keep your clients in tune to, the market challenges and the environment, and keeping that and making sure that they're staying in front of everything on their side of the fence. And that way, when market does change and the environment does change, they're ahead of the game and they're prepared for it and they're positioned well, and they can, they can live through some of the waves and challenges that the environment will throw at you. Because clearly you can see that it may not be identical, but history does repeat itself in the sense that, our industry are going to experience challenges every few years. It just happens to, it just is how it's worked out, right? And like Gary said, there's going to be winners and losers, and you want to make sure that you're on the winning side. But I guess the last thing that I'll say, it all goes back to, it seems like multifamily and residential, because of the fundamentals and because of our market, is, it is a great hedge against like all of the other asset classes and the challenges that they're going to see maybe in the near future that Dan was kind of talking about at the beginning.
I think that, I look at the real estate industry and multifamily as these like mini ATMs that small business owners can buy into and use the cash flow to grow their portfolio. And I love that that's how it works and how simplistic that statement is. You know, what it comes down to for me is having a good mix of relationship lenders. You have to have in your portfolio a couple of good relationship banks. You have to have an acquisition lender. You have to have good refinance lenders to provide permanent debt financing for those properties that you're going to keep. And I think that what always is very important is when you understand the nuances of financing and what makes the different lenders tick, you can recommend which lenders could help them reach their goals. Because sometimes it's not just, oh, I have to refinance every 10 years. Sometimes you have to take a couple of steps to get to your end goal. And relationship lenders understand that, and they can be there for you.
Yeah.
Dennis, you wanted to comment. Go ahead.
Yeah, I wanted to comment on Gary's thing. So to your point, the syndicators and the folks that bought properties the last couple of years, and maybe that's the new normal of values, I agree. The short-term conundrum is that even if they hit all of their metrics and did everything right and raised the rents, and they may have bought it and rates are at 3% or 3.5%, and now depending on the property size and leverage, et cetera, it could be anywhere from low 5s to 7%. The deal might not work from a debt service coverage. Again, it's a short-term problem. So what do? Do they sell? Are they able to go back and do a cash call with their investors to do a cash in, write a check to refinance? That's the short-term conundrum. And it remains to be seen how many of these types of situations are we going to see. Speaking for Kathryn, some of our mutual clients, we know that some of these folks are going to do just fine. They hit their numbers on some of the deals they purchase, and they can refinance out. They will be fine. There's others that are going to have to write a check. And the question is, will they be able to get more cash from their investors to do that if it's not, their own equity and they're not well capitalized? The clientele that we have that have liquidity, that are well capitalized, are going to find some opportunities.
I don't see any big distress selling from that perspective. Again, a lot of people are like, oh my gosh, it's sort of like, in COVID, and we'll talk about that in a minute. It's like you're going to see this, tsunami of, opportunities like after the savings and loan crisis. And I wish I would have been just a little bit older and had a little bit more money at that time. Because I'd be in Bali right now on a beach. But because
instead of Arizona and 90-degree weather.
Exactly. Yeah.
We at least have some sun today, though.
Exactly. But well, let me just jump back to COVID. So, again, the world was crashing then. 40% of the people weren't going to pay. And, we've gone on this podcast and we've all talked, and we don't need to repeat, like, everything they predicted didn't happen. And in fact, if anything, it strengthened everybody's resolve in multifamily. But this is the first time I get to ask a direct question. You don't have to tell me, obviously we're not going to talk about specific borrowers because of client confidentiality. But did you have anybody go back to Fannie or Freddie or in the CMBS world and say, geez, we can't make it, we need a forbearance, or we need some kind of, the programs that they set up? Did you guys, I know it was less than 1/10 of 1% of people took advantage of the programs that were sort of proposed by the agencies. Did you guys have any clients actually, they're like, oh, we got to stop paying our mortgage for a while and did a forbearance program or anything?
I can comment on. Go ahead, Kathryn.
I had none. I had, when it first started, people calling me saying, should I reach out to my lenders and get a pause? And I told them, think really hard whether or not you want to do that.
I had a couple that did it who were very, very conservative, but they never used it. So they were like, oh my God, we better get this. Let's sign up just in case, but they never needed it. And then I had, but they had to explain that they took it but never used it. So not the end of the world, but very, very conservative. The biggest thing that I saw with owners with COVID was navigating and figuring out how to get some of the quote free money, some of the funny money that was being doled out from the government through different small agencies locally, so that they could help their tenants that were displaced, that couldn't go to work. It took a little while to figure that out, but once they did, that was a real help to make sure that the tenants that were unable to go to work would stay afloat, because there was money out there for that.
Oh yeah, I can't tell you how many offices of clients we were in, and they'd sit there and show me a check. Oh, look, this is a check from certain organization. It's like $10,900, and they literally paid not only for 3 or 4 months,
Right.
as somebody was, but that next 8 to 12 months of their rent. So it was unbelievable how much capital came in. Even from the REIT perspective, I know that Equity Residential, for example, had 35 million in rent relief payments that came in, the third quarter of last year, for their thing that isn't being repeated now, but yeah.
Yeah, the interesting thing is how the owners had to become nimble, because the tenants could not figure out how to navigate to get that money, generally speaking. So the owners had to train their staff to figure it out and help them go get that money to get their rent paid. And they did.
Yeah, no, the leasing agents and property managers, man, they were on top of their game. So,
One of the things that I've seen lately, and I'm kind of surprised by it, but there were a couple of business owners that went after idle money, and those loans are now, you have to start paying for them. I've only seen one client call me and say, I don't want this loan, even though it's a 3.75% loan, and I got it, and it's only $40,000 or $50,000. I really don't want that money. What do I do? Well, if you were in tight shoes and didn't have the ability to make those payments on top of your other debt, you are concerned. But for the most part, I've had many clients just write a check, give the money back.
Yeah, no, I think we've seen it from at least tangentially some of the stories that we've been told.
So Dan, I have a question for you. I'm going to go back to a comment that you made, and you were saying kind of, in terms of maybe some of the challenges on how certain groups that may not be so well capitalized, how they're going to get out of this short period of time where they may not be able to refi and they may have to have some sort of capital call. You made a comment that some of the more well capitalized groups, there's going to be some serious opportunity for. Is that like are you meaning, because like Gary's saying, hey, we don't think it's going to be like this wave of like a bunch of distressed sales, but are you meaning more like JV opportunities for groups that are in the market already, that are well capitalized, that can come in and help some of these groups bridge that gap?
Yeah, I think there's going to be some of that. I think and after the last crash, there was some of that with a couple of big real estate developers in Columbus, without naming names, where they had somebody come in and recapitalize them, basically become their partner, and they've since grown tremendously. I think there's going to be that. I think there's going to be opportunities for folks like my employer, our firm Basis, for larger transactions to provide mezz and pref equity, to provide that kind of capital that they need to on the short term, to recapitalize and get out of their debt. And I think, to your point, I agree, we're not oversupplied, so we're not going to have issues, like other downturns, but there are going to be some instances where investors are not going to be able to get cash out of their equity partners, and they're going to have to sell, or they're going to want to sell. They're going to decide that that's the best thing to do, is to sell the property and get what they can. And, that's where the well-capitalized owners are going to come in, and I don't know if they're going to get a great deal, but they're going to be able to buy some properties maybe that they were unable or unwilling to purchase in the past.
I wonder how if the agencies are going to go back to some of their substantial discounts as it relates to green financing. Back in 2015, I did one of the first Fannie Mae green financing deals after a developer constructed an apartment community. And because they built it with green financing and green energy efficiency, they were able to get a substantial discount on their interest rate. We really haven't seen very many deals go forward with any kind of green financing discounts because the agencies had pulled away. Dan, do you think that that's going to change soon with some of the undercurrents of what our government wants to have, and make some of these Fannie and Freddie monies contingent upon changing some of these, the boiler rooms, the electricity, the gas? We've got a lot of apartment communities that are really old, and it's not about changing shower heads and toilets. It's about doing a lot more. What are your feelings on that? What are you hearing?
So first off, there's two benefits to the green programs with both agencies. One is a pricing break, and two is being able to leverage part of the savings, basically get a bigger loan. So, and of course, the other benefit is for the owner.
Can you guys define what, significant is in terms of interest rate credit? I mean, are we talking 10 bips? Are we talking 50 bips?
The issue with the agencies is that they've been giving discounts and been charged with giving discounts by the regulator for affordability, not necessarily capital A affordability like a HAP contract property, but a workforce housing property where the rents are affordable relative to Kathryn's previous comment. And those discounts could be significant. It could be 20, 40, 50 basis points, overall, everything else being equal. So it brings down the rate a lot. And what the agencies are not allowing, if you will, is a double dip where you can take a full green discount and add that to an affordable discount. They've kind of enveloped one into the other. So the incremental discount that you could get if you have a property that's workforce housing and is using a green program might only be an additional 5 or 10 basis points, to Kathryn's point. But both programs still exist where, roughly speaking, if an owner agrees to put into place things that affect a 30% reduction in water savings and energy, half of which would have to come from energy, they are able to get those discounts and pass along savings for their cash flow to leverage, and also pass it along for the benefit of their tenants.
I have a question on the green program. This actually just came up yesterday, and I didn't have the answer to that to this, but in order to qualify for the green program, are you able to have a gas central boiler, or does it have to be all electric, the building?
There's talk of wanting to have all electric buildings in the future. That's not done yet. But certainly we've done green deals where there's gas boilers and gas appliances. So that would absolutely qualify. So what happens is a report is done, and the vendor goes out and recognizes and finds all of the different things that could be done and what the associated cost savings would be ongoing after it's done, and then what the cost is to do the particular job. For instance, thermostats or aerators or changing toilets or putting in energy efficient appliances or windows or caulking or sealing up the building, things like that, or putting in a continuous pump on a gas boiler, which provides a big cost savings in energy.
Okay. I want to pivot a little bit here, and especially since we got two very experienced folks that have seen a lot, and really talk about best practices, right? A lot of our listeners here, again, they're sort of tuned into some of the capital markets discussions and some of the economic discussions, and they can listen to TREP and some other things to get that. But I'd love to hear from you guys talk a little bit about best practices. Here's your chance to sort of read the riot act to your clients that you want to read them to, but you can't do it directly. So we can talk a little bit about what to do. And, Kathryn, even from you, I mean, obviously the largest apartment operator in Northeastern Ohio is K&D, and I've known Karen and Doug for a long time. And they've been phenomenally successful. You and, before you started your own firm, when you were with Jeff, you guys did most of their financing and seeing what they did. And I mean, I think that they, from an operations standpoint, they're the best in the business. I think from, what they did on the capital markets and how they sort of had first, seconds, and thirds and used financing and relationships with M&T. You know, if you can talk a little bit about, you know, hey, what did you see from their practices and what would you like to see your clients do? And then we can talk, you know, have Dan spit around that as well.
Well, I think part of what makes me unique is when I start doing when I'm in a new relationship and I go to some of the apartment buildings in their real estate portfolio, and I walk around with the owners and I point out some of the things that they don't care about, that are big capital improvements that, you know, they get to every refinance cycle. But I think that the good owners always make sure that they're keeping up with everything, that they're not waiting to the last minute to do roofs. They're not waiting to the last minute to do cement work. They're not waiting to the last minute to spend money on the boiler systems. My best clients are those that know where they're spending their money. They know how many units have gone through renovations, and they know without even a hesitation what's next. You know, every time we go to refinance, and especially when there's a cash out need, I am surprised that some of the owners don't keep as much better books as to where they spent their money. And they kind of, you know, begrudgingly get to the information to help me sell the refinance cash out. When interest rates go up and they need to refinance and they want to pay themselves back for all the capital monies that they spent, they have to have good records, and a good business owner, their best practices keeps track of what they spent, where, how many units are left to do. And it shouldn't be a mystery. It shouldn't be a question that you can't easily put your fingers on. And I think that some of the smaller, newer owners who have yet to go through an agency loan, they get some education from me. And I'm telling them what they need to do after a loan closes to make sure the next time they refinance or need money, that they don't have to go through all this hard work again. It's simple. Keep good records.
And you know, Kathryn, that's why you know, that's why we push anybody listening that's a property owner here. Call us, have a broker opinion of value done every single year. And there's, before you file your tax return, your financial statements, because again, there's going to be things that we can identify that you can improve in case you did want to refinance in the future or sell. Because, you know, Kathryn and Dan, as you guys know, you know, and us on the broker side too, right? You know, yeah, we can tell a story about anything, but the more stories you make us tell, the less likelihood that it's going to be successful for you. Right.
And normalize your expenses. Like, go when your year end is done and you're having to put together your books for your accountant, whether that's in early April or if there's an extension in October, normalize your expenses. Now, you can be a little bit more wiggly if you don't have a refinance coming up, but at least 3 years out, make sure that you're capitalizing what you should be capitalizing. And if you're going to a lender that is going to rely on a tax return, what you use in your expense line will matter more. Now, the agencies don't rely as heavily on tax returns, but it's really important to know when you have stuff due and what you should do from a management side of things to make sure that you're normalizing your expenses, especially when you're about to sell.
Yeah. And I'll define normalize for you a little bit in the sense that, you know, a lot of people, as we know with owners, they, you know, understate income and overstate expenses. Not only is that illegal and you can go to jail for it, but it's not a smart move for a sale or refinance either. But in normalizing, you know, again, there's certain things that people, I'm just going to expense it. You know, new carpeting, you know, it's something that again has a lifespan of more than a year, that they should properly be capitalizing so it doesn't hit the income statement. What they don't realize, obviously they're generating, almost probably a taxable loss anyways. So again, trying to generate and they'll get bonus depreciation in section 179. There's a whole bunch of other things they can use to properly get that accelerated deduction, rather than just claiming, oh, it's, all the new carpeting put in the units is an expense. It's not an expense. It's again, that is definitely an item that should be capitalized. And they all think, oh, I'm going to save a few bucks on taxes or something, and all they've done is give us put one more boulder on our shoulder to sort of when they come to us for help. And unfortunately we end up looking like Hercules most of the time. A lot of these folks, but I agree with you. Record keeping is a huge one, not only in terms of what they've done, but the CapEx, and it's so easy to record it at the time, right? When we replace a boiler, put this, or any of the cap, any of the structure, get it down on a document, even an Excel sheet, and just keep it there. And because again, everybody we ask, they don't know, when did they replace this? We don't know. How much did it cost? We don't know. But then they're like, but I should get X dollars for my refi or my sale because I did these things. And then they can't prove they did those things. We just expensed it. It's just normal. No, it's not.
I've seen a few instances where, and we get this from them to do the refinancing, where they make a list per year. These are the things we did, and here's what we spent, and we can go see it. They provide pictures. Here's the roofs, here's the parking lots, here's the appliances, here's the boilers. This is what we spent, this is what we did. And shame on them perhaps if they had put those in their expenses. They weren't obviously doing anything wrong, but to normalize them or recapitalize them, show them as capital expenses as they should, then is not so hard.
Yeah, they just dramatically help themselves. So besides obviously some of the operational kind of things, again, what advice would you give to a borrower today? We haven't talked about, again, net worth. We haven't talked, it's funny. I remember back, and this would have been sort of at the end of National City Bank's life with Marty Rodriguez and all the crew that was there with, Doug and Karen. And they were like, they were sort of setting up Doug and Karen, their balance sheet, making sure their liquidity was different than it was, and sort of setting up all these sort of proper financial things. Is there advice that you'd give to a borrower from, hey, how much liquidity should they have? What they should be doing, other than the property aspect?
I'll comment on this first. So in agency land, generally speaking, we want borrowers that have requisite amount of experience. It can't be their first multifamily deal, generally speaking, but they need net worth equal to the loan amount they want to borrow, and they need liquidity if it's a smaller loan equal to 9 months of P&I payments, and if it's a larger deal, at least 10% of the loan amount. Now, as the loan amounts get rather large, there's a little more flexibility on that. If you're doing a $50 or $80 million loan, you don't need 10% liquidity at that point. It's a lower number, but it's still substantial. The other part of advice I wanted to impart, and I'm sure you're seeing this too, everyone is on this call, is insurance. It's out of control. And we see insurance come back on deals that we're refinancing or purchases where it ends up sometimes being multiples of the previous year's insurance premium. It's crazy. And my advice to head that off for any owners is to very early in the process, go and get your insurance quotes. If you know that you're going to be closing a loan on a purchase in June, tell the agent you need the insurance quote by May 1st, because, right or wrong, there might be some games being played, but the insurance agent comes back at the 11th and a half hour right before you have to close, and the rate is through the roof. And then as an owner and as a lender, we're all stuck. Whereas if they worked really hard, they might have been able to find a better quote. I've seen that in practice a few times. And one of my clients did get a quote that was double the previous year, and he worked really, really hard, and unfortunately was at the last minute and ended up getting insurance that was maybe 20% higher than the previous year. Because insurance is up. Replacement costs and the cost to do things is up. And, fortunately for us in our area, we don't have a higher incidence of losses due to natural things like the coasts and et cetera. but still, it's
But
a
we have
real
old
problem.
buildings.
Yeah.
We have old buildings in Cleveland, and I know that insurance, anything under like, or anything that's older construction than 1980, is like getting an additional like, risk layer tacked onto it.
We have a lot of parking garages that are really, really old. And what's acceptable in a parking garage in Northeast Ohio, some of these lenders, they don't find them acceptable anymore. You got to spend some money making sure that you're securing that area. That's not a moneymaker for you. It's an amenity.
Yeah.
Sure. We sold a deal in Lakewood last year. And you guys probably all know the city is now making owners of parking garages in the city of Lakewood get engineer stamps on them, just to ensure they're structurally sound and safe.
I have a client who has a property in Lakewood, and the lender has been out 3 times. The lender, the servicing team, and now actually the Fannie Mae lenders out today, just going through again and kind of, driving the owner crazy because he's like, I did it. It's fine. It's beautiful. Well, if there's still some leaks and there's still moisture, I mean, last week it snowed. This week it's sunny. It's only April, but they don't seem to care that Northeast Ohio has water. And it is a concern for the agency lenders. The other thing that I think is very important to remember is some of these investors' perception of what we can use when qualify them for cash is always a concern. So, as more and more people may be dipping into their long-term savings or their 401ks or IRAs to make some of these improvements that are needed in the properties, if they don't have the proper cash flow, it's concerning to me that they don't realize that cash is important. Cash in the bank matters. Cash in the operating accounts is minimum, but certain banks want relationships and they want people to bring extra bank relationships to the table on a deal. Agencies don't necessarily want you to change your bank structures, but it is important to make sure that you're making good decisions about your financial strength and evaluate your personal financial statement and understand what nuances within that personal financial statement are more important than others depending on the lender that's looking at it.
Yeah. Can you tell us a little bit, and Dan, you could chime in as well on this. Curious to know how you go about shopping lenders.
I think that's a Kathryn question.
Well, what matters to me, I always thought that you had to have a really big important name or a really important logo associated with you. And now that I've had 20 years of experience, it's not the logo that matters. It's the deal team. It is one of the reasons why I've always worked with Dan is he surrounds himself on every single transaction with a packaging and underwriting, a credit officer, a servicing team that is relationship driven. So when you're evaluating what lenders you want to surround yourself with, you always pay attention to what happens after a loan closes and how are your clients treated. You don't want any owners that have closed a loan with you that are jumping up and down that you gave them such a great rate and then are hassled to the end of the loan term. You have to be able to be honest and respond to your lenders. Your lenders have to be able to communicate well and understand that the lenders play a role in the success of not only the transaction that closed, but the success of whether or not they will go back to you in the future.
Again, gets back to relationships.
Yeah,
Always.
100%.
It's a relationship business. We can't screw up. We can't provide somebody with bad service or have a bad, the bad things happen, and you communicate and you're transparent about what happens. But at the end of the day, we have to have integrity and do a good job.
And when your lenders call you and ask you, 3 years in, where are you spending money? Or I've come out to the property and I'd like you to focus in this part or that part. Don't ignore them. Don't treat them as the bad guy. They're looking out for themselves and for your best interest as an investor to do what's important to keep up for their regulations, but also to keep up with the competition.
Mhm.
Yeah, no. And, we sort of warn our clients, because I tell them, look, if I'm getting a call from the Mike Dostals of the world asking if I could help with getting the guy's financial statement that he was supposed to provide every year or whatever, it's like, hey, that's the wrong thing to do. And so a lot of our clients, we teach them, hey, relationships go both ways. If you expect people to jump on one side, and do things for you the right way, you've got to do the right things for them as well. And, how many clients just say, again, they've got they got to provide annual financial statements and annual tax returns and annual rent rolls and whatever they've got to do from a reporting structure, right? And they act like that it doesn't matter. It's like, oh, I'll get to it when I get to it. And we always sort of really preach hard on our clients. Look, when they call, jump, get them the stuff right away. And, first of all, you need to be prepared to be able to do that. And, ever since, we've all been talking about global cash flow statements since the Great Recession, right? So people are sort of used to that, but it's like, hey, keep this stuff. If it's due by March 1st, give it to them February 1st. Don't treat it like the tax return where we all do them in October. Because again, each one of these, as the people servicing it, the loan officers, the loan originators, they get dinged and they get asked as well. And again, I've had bankers say, hey, we think the guy's a great guy. We know he's super competent. Obviously, his financial statement and reserves are great, but he's a pain in the ass to deal with. When I try to get financial statements or tax returns in the future, he's not going to respond. And, then I get in trouble and I get dinged. And so I'm not doing a deal with that guy. I've heard that multiple times, enough to where it's like, again, your reputation on what you are supposed to do and what you do is just as important as what you're expecting from the other side.
I go back to your question earlier. What advice do we have for borrowers? And I think you brought up a really good point. Create or have someone like myself or Kathryn work for you and help you create a global real estate REO schedule. Have it flow through to your financials so it updates the debt service coverage ratio. It's a pain in the butt to start it and initially do it, but once you have it, I have clients that have this. It's beautiful because every lender, you can send it to them and click it in an email and they have it, and they can see exactly where you stand in your portfolio and the specific property you might be looking to finance in terms of debt service coverage, where you think the value is, current debt, et cetera, et cetera. Again, it's a little bit of effort to create it, but it is really big, and it will save a ton of time, and you'll gain a lot of respect from your lenders.
And again, I know you guys get bugged more than I do about clients, again, not providing stuff that they're supposed to provide. And probably Kathryn, you as much as anybody, then you've got to jump all over the client to try, and then they want you to do it. Because that ends up happening to me. Like, oh, I don't know how to really work QuickBooks, so can you help me come and prepare this stuff? And it's like, wow. And you guys know our clients, and I've been in situations with both of you like that. It's like, oh, holy crap, Gary's got to go do it, kind of thing.
Well, the other thing that, as this world that we live in changes, I think it's really important. And I have a perfect example. About 6 months ago, one of the lenders was challenging one of the apartment owners, and the apartment owner got upset, and they were trying to speak. And one of the younger individuals on the phone didn't act like a lady or a gentleman. And one of the things that I know it's my age, and I know that we're all the same, but you have to remember to take a step back, and act like a lady and gentleman in the way that you respond and conduct yourself. Even if somebody's pointing a finger at you and wanting you to do more or do things differently, you can't lose it. You have to be able to take a deep breath. I literally, after a phone call, had to call my Fannie Mae lender, and it was not Dan. And I had to say, what were you thinking? This is, you are not respectful in your tone. You are not respectful in the way that you are delivering your message. Like, what are you doing? And I at first I thought, oh my God, they're going to hate me. But they called me back and said, you know what? You were right, Kath. I did lose it. I did not act the way that I should. And as this younger generation of apartment owners come more and more into our market, we're going to have to like get them to take a breather and relax in their response. Because we've been there, done it. We've had these tough conversations behind the scenes, and they need to be able to respect those that have that experience to say, trust me, say little or say it this way. And I think that's important.
I'm going to create a boot camp for them. All the sort of millennials and Gen Z that want to get into business, they're going to come to my boot camp, and it's going to look just like the military. And
Yeah.
man, we'll get them in shape. They'll be organized. They'll be disciplined. They'll be respectful. They'll be able to follow structure. You know, none of this crap that goes on with work from home and everything else. So
there you have it, folks. Gary Cooper, real estate boot camp.
Exactly. So
Yeah,
Dan, as we wind up here, talk to us a little bit more about basis. I know, obviously it's the new entry into the marketplace. And you're doing it. I think basis has some pretty unusual kind of attributes, and maybe we'll let you give just a quick commercial on that.
Sure. So on the surface, in terms of agency, Basis is a Freddie Mac small and conventional lender, and they are also now a Fannie Mae conventional and small loan lender, doing conventional and affordable. They got a Fannie Mae license recently in the last 6 months, late in 2022, which is really big. They obtained it through an application process, not by buying another company. And I can't tell you the last time that happened. It's not easy to get
a decade or more since there's been sort of a new one granted, right?
I believe so. Yeah, not an easy thing to do. So, and the company is already closing a portfolio of Fannie conventional loans, I think next week. Can't comment on what they are yet, and they're not here in Ohio, but they're well on their way. The other things that that Basis does is they have investment funds that they've raised. Luckily, they did the last one before the rates took off last year, but they use those funds to make opportunistic investments in pref equity, mezz, bridge loans, and pure equity plays, where they will partner up basically with certain borrower, developer, investors, and be their partner in deals, provide the vast majority of the equity needed to take down a property, or in some cases, even to build a property. So the cool thing about this firm is that they don't have a lot of legacy issues, negative legacy issues relative to bridge loans with the CLO market, or being subject to having to sell deals into a CLO collateralized loan obligation. The market's been very disjointed for the last several months. And they also don't have, some of the related issues with those deals where you had interest rate caps and the cap costs went through the roof, and you have borrowers that are scrambling, trying to figure out what they're going to do to either replace the cap or potentially have to sell or recapitalize the property because of that.
Yeah. And it's not a combination of 3 or 4 different huge entities that all created this new entity. So you've got these cultural wars and sort of, you just don't know which side's going to win. In some of these things that we've seen on the brokerage side of it, that I'm sure has happened on the mortgage banking side as well.
Yeah, it's a cool shop. It's got some very good professional people here that have come from different places. There's a very much a can-do attitude, and they really want to do business. So, and even with smaller borrowers, it doesn't have to be the biggest Class A type sponsor. They're willing to do business with on deals that make sense.
Where's Basis headquartered?
So they're headquartered in New York, in Midtown, or closer to downtown. They're actually moving their offices sometime next year. And we also have offices around the country. So I think the next biggest office is in Southern California.
Okay. Good.
Fantastic. Well, Dan, Kathryn, I really appreciate you guys joining us today on the podcast. I think we had a pretty fun and informative conversation. I know both of you are very active on LinkedIn. If folks, listeners want to connect with you, Kathryn, any other good spots where our listeners can reach out and find you?
I'm always a phone call away.
Okay.
I like to be under the radar.
Okay.
You know, as Dan knows, we surprise people all the time on the people that we work with and the loans that we'll touch. But they still have to make sense.
Sure.
You know, as a loan correspondent for agencies, I'm excited about to be able to talk about a new lender and to be able to talk about the experience of Dan. I know they've made the right decision in Dan, and he's got a lot of experience, and he's going to have to lead the way. And hopefully some new real estate owners will help him be as successful as he always has been.
Thanks for the nice comments. I just one
again,
more pitch I wanted to
sure.
mention it. Sorry to interrupt.
No, not at all.
I just want to further the point that no matter what happens in this market, if things become disjointed, if credit becomes tight with banks or credit unions, the agencies, Fannie, Freddie, and our firm and our competitors, we're charged with maintaining liquidity in the marketplace. And to Gary's point earlier, the sky is not falling. There's plenty of money out there, and we're here to help you get your business done.
Well said. Well said. Listeners, you can find Dan at Basis Investment Group. That's basisinvgroup.com. Again, both Dan and Kathryn are active on LinkedIn. Feel free to reach out to a Cooper Multifamily team member if you do want to connect directly with them. Thanks, guys, for joining us. We really appreciate it.
Thank you, guys.
And it's been our pleasure. And thanks for listening.
Thank
Thanks,
you.
everyone.